Our second speaker this morning is Dr. Sacha Vidler, who's the Chief Economist with Industry Super Australia. Industry Super Australia is the industry organisation, if you like, of the industry super funds. So that group represents the various industry super funds. Sacha is the leader of their policy and research team, which undertakes research, analysis and economic modelling to support public debate on superannuation, with the goal of improving the equity, adequacy and efficiency of the system. Sacha is the author of Supernomics, an analysis of consumer inertia and the inefficiency in the superannuation market, and was the lead author of ISA's submissions to the Henry Review and the Cooper Review, and an advocate in the stronger super implementation processes that followed. Among previous roles, Sacha's taught finance at the University of Western Sydney and worked in environmental policy at the New South Wales Government, and he has a PhD in economics from the University of Sydney. So to give us the perspective of those superannuation investment fund managers that sit there in Australia and make decisions about all that money, please welcome Sacha Vidler.
Thanks very much, Mick, and thanks very much for the invite. I work in the chronically tedious field of superannuation, so it's been great to be here for a day and a half to hear about this interesting area of farming. But you can hear from my bio that there's no farming or agriculture in my background, so I'm not an expert on that. So here goes nothing. Definitely need to make that first slide. So maybe it's just it's off. Yeah. Turn it on. There we go. Okay, so what have I been doing? As Mick explained, I've been looking at these reviews into superannuation. It's been a busy time here in review, Ripple inquiry, the Cooper review, lots of changes in super, and it doesn't stop. Right now, we've got the Murray inquiry, the FSI, the Son of Wallace. Looking at the finance system, including the cost of super, but also a lot of focus on how super funds are invested, and also the interaction between banking and super. So this question of where super fund money goes is very topical. Just a bit of a laugh to start off with. Farming and finance go way back. This is a slide I used to give in my lectures on derivatives. The earliest written records are farming derivatives. This is a futures contract for barley from 500 BC, written in cuneiform, tablet now at the museum. So these issues of finance for farming, risk management for farming go way back. Just some basics, which I hope will come in useful later. Superannuation, what is it? It's an occupational pension system. So as you work, you acquire rights to retirement income. The key there is that the money, the income you're entitled to is preserved. You can't get it, broadly speaking, until retirement. As you know, there are employer compulsory contributions. They're now 9.25, and they're rising to 12% under current policy over the next 8 years. It's still growing. So it's still a maturing system. Super, for what super is enormous. So this is assets over GDP, 1997 to 2013. During this period, of course, GDP has grown consistently. Nonetheless, that ratio has continued to rise. Super assets now comfortably above GDP. Talking about 1.8 trillion in assets plus 300 billion in unfunded liabilities. That's effectively assets for public servants and former public servants. It's early days. As I said, the system's still maturing. However, the industry pays out over $70 billion in benefits annually. That's more than double the age pension. And to give you a sense of scale, as you know, employers have to pay contributions on behalf of workers. Most employers do the right thing, but some don't. Some money goes missing. about 1% of the employer contributions go missing. Now, from the ATO's perspective, they're the regulator, that's pretty good compliance, it's 99% compliance. But that 1% each year is $800 million. Now, that's just the crumbs off the table from the flows, the big dollars. The industry is also quite complicated. Various segments, the major ones you might be familiar with: corporate funds and public sector funds, industry funds that we represent, the retail sector, the major wealth managers owned by the banks plus AMP mostly, and SMSFs or small super. Same data in percentage form, so you can see the change in market share. Corporate has shrunk away, public sector shrunk a little bit, it's pretty consistent. Industry's grown, retail grew and then shrunk, and the big winner is SMSFs. Now about a third of industry assets. So there are different segments. I'll talk about the similarities and the differences. They're important. All super is formally in a trust structure, so the trustee controls it as a fiduciary duty to the beneficiaries, and they must use the prudent person approach to investing. This is rooted in trust law. It's not investment generally isn't regulated, but you've got to use prudent person. We'll come back to what that means a bit later. Most super, not quite all, but most super is funded, that is, there are assets held against the liabilities. Most super in Australia is defined contribution as opposed to defined benefit. The money we've heard about over the last couple of days coming from overseas into farming and other assets in Australia is largely from DB schemes. So the benefits there are formulated, they're on basis of a formula, they include salaries, they include CPI. So those investors are looking for assets to match those liabilities. Our super funds have got a different set of issues. It's mostly privately administered, which is a key factor, so it operates in a market. This is relatively unusual. It's becoming more common globally. But certainly when it started in the 80s as a universal system, it's quite unusual. And it's not leveraged. So this is a big section of the finance system which doesn't borrow in order to invest. SMSFs, you may be aware, are starting to leverage up some property investment. It's still relatively limited at the moment. Some differences between the segments. So our bread and butter at Industry Super Australia is drawing the differences, attention to the differences between us and the retail sector. They include that we have representative trustee boards. They consist of union employer group representatives, whereas the retail sector has professional trustee boards and are owned by the banks and life insurers. The distribution systems are different. Basically, the not-for-profit funds, this is public sector, corporate industry, workplace default funds, that's where they get most of their flows from. Whereas the retail sector gets most of their flows from advisors. This is important as well. The other thing to draw attention to is differences in fees and differences in returns. This is over about 16 years. So the differences in fees are historically about 80 basis points. Just differences in returns about 160 to 200. And that actually, not just by the one, that is relevant going forward. We'll explain why there's more to the difference in performance than the difference in fees. Where's the money invested? Well, SMSFs, this is a difference by sector as well. SMSFs is mostly cash and local equities. That's pretty simple after the frank dividends. That looks reasonably diversified like that. It's not. We've got data that shows that for an individual SMSF, it's either all in cash or all in domestic equities. Suddenly when you put them together, that they look like they're nicely diversified. In the retail sector, it's about half equities, local and foreign, and then about half bonds and cash. And the industry funds were also about half equities, local and foreign, and then the other half is made up of cash, bonds, property, infrastructure, and private equity. there are some important differences there, and that, at least historically, explains some of the differences in performance. Unlisted property and unlisted infrastructure have performed very well for the last 15 years. So investment's largely about the numbers, and we'll come to that, but it's also about the people, and there are lots of decision makers involved at our funds. The trustees are involved in the strategy, they have investment committees, sometimes with outsiders, they have internal management teams who are focused on investment, they have specialist consultants on strategy, asset consultants, and then they have fund managers who actually do the investing. And if you're looking at investing in a new area, you sort of have to have comfort all the way through this chain. And if anyone along the chain doesn't understand, isn't comfortable with the data, raises more questions or says no, it probably doesn't go ahead. So, in terms of, it's a chicken and egg thing, but in terms of getting a new asset class up and getting it, resonating through the industry and getting a decent allocation, you've got to educate a lot of people about how it works. It's not just about the numbers. If an asset consultant doesn't cover agriculture, they can't recommend on agricultural investment. It's just not a part of their universe. And this is a real factor. So super and farming investment, well, the SMSF's essentially a tax-effective personal family investment vehicles, individual decision makers, often advised by accountants. It's hard for me to comment really on whether that's an opportunity or not. There's a lot of money there. Probably there are opportunities, but probably at a small scale, probably individual. You might be able to come up with a model which can aggregate some of that money, but it hasn't been done yet to my knowledge. In the APRA regulated funds, that's the rest of the funds. They're large, they're diversified, they're pooled, they're long-term investors, and from what I've heard in the last couple of days, that is appropriate, broadly speaking, for farming investment. So, is there an opportunity? I'd say there is. There's a demand for nation-building investment on the part of our funds. So in principle, yes. And it comes down to the detail. So I'm going to spend the rest of the presentation thinking about that. A lot of this we've already heard in the last couple of days. Obviously, there's the macro story that was discussed by David, among others. There's the population chart prediction. So it's going up. It's not going up forever, but it is still going up. Just dwell on it. What matters is the middle class. This is data from the Brookings Institute and the World Bank. Broadly speaking, it shows that the global middle class has increased by 2.5 times over the last few decades, and will increase by about 2.5 times in the next couple of decades. The prediction is neither here nor there. It is interesting that this has already happened. So on a logarithmic scale, that's consistent growth. It's not like, I don't think the growth is jumping out of the floor. There's always been that growth. It's just we're getting to a steeper part of the curve. And that potential is being realised, at least in Australian exports. This was news to me, but rural exports have grown very strongly, 3+% real for quite a while. And it's also got more diversified. The other category, which I guess means everything besides beef, cereals and wool, is very significant as well. Presumably, we've got trade barriers falling, at least at the margin, so the opportunity is growing. And there's also a micro story. Arguably, there are farms that are losing money, but they are potentially viable with the right capital and with the right expertise. I think we've heard a bit about that today. If you can get the debt down, if you can make the investment, if you can get a good manager who's got skin in the game, there's potential model there. If you can achieve the diversification you need with the right level of investment. So there's room for value add, there's room for institutional investment. However, we've already referred to this data this morning. This is FAO food indices. So this is real. The thin lines are the different individual commodities, and the thick line is the food So this is real growth after inflation. I think, you know, the trend is above zero, but it's not way above zero. So you've got a couple of decades where the global middle class has increased by 2.5 times, and that hasn't yet flowed through on the price. Maybe it has in the last 5 or 6 years, but you know, from the data that I can find, at least it's not my industry, it's not my data, but you know, it looks like there's a lot of volatility, and the trend is just above zero. So there's still, you know, doesn't necessarily flow through into revenue. But, you know, volatility is not necessarily a killer. Obviously, most of the money in super is in equities, and there's a lot of volatility there, and that's managed. It's a question of appropriate diversification. So how would our industry look at this? Well, it sort of has to fit into this chart somewhere. I've got, obviously, apples and oranges here, but this is risk-return space. Here's our volatility. Here's our returns. This is where you want to be. Zero volatility, very high returns. That's desirable but unattainable. This is where you want to avoid. The line, I guess, is, you know, they're the biggest asset classes. They're the sort of default asset classes in a sense. Those are your reference points, right? If you look at Australian equities, lots of volatility, but you're being compensated for it, at least, you know, in the last 17 years. And where you want to be is above that line. That's good, and you see unlisted infrastructure up there, at least for the last 15 years, is above that line. That's contributed to industry super's good returns in the last 15 years. However, you know, there's no guarantee, of course, that you're going to get the same returns in the next 15 years. And when you were buying an airport in the late 90s, there were less people bidding for them than there are now. If you were buying a road, there were less people bidding for them than there are now. There was a lot of advantage from the secular fall of interest rates during the 90s. That advantaged a lot of infrastructure investments. So the point is that was a big asset class. It was largely pioneered by our funds in the superannuation context. It delivered outperformance. It's very valuable, but what's going to deliver the next 10 years, next 20 years outperformance? And that's something that our investment professionals are constantly looking for. Other points. Food is lower, you see. If you take the aggregated measure, obviously it takes a lot of volatility out, but it doesn't get you up near the line. But, you know, that reinforces the importance of that micro story. There's still an opportunity, and obviously this is real return, so we're above inflation, which is good. Just left one point out. Okay, this investment in equities, right? Across the board, it's 50% in equities, and it looks like, and we think about it as a very diversified asset class. Okay, but we know that the Australian equities market is not diversified. It's dominated by the ASX 10, really, is most of the market. It's the big four banks, it's a couple of big miners, a couple of big grocers. Right, so there's actually a great deal of concentration within the super fund investment in these, 10, 20 stocks that make up the top of the ASX. And it's an important factor when you think about the investment universe for super funds. Okay. So farming investment, it's not impossible. Indeed, I'd say it's desirable. I know at the margins it's happening, and it's certainly being looked at in more detail. Super funds talk all the time, we certainly do, about nation-building investment, and this is entirely consistent with that. It seems to me it would take work to make it work on a large scale, the sort of numbers that we're talking about in the super world. But that's not necessarily a bad thing, right? If it was easy, everyone would be doing it. We're looking for differentiation. We're looking for a model we're using which is better than the competition's. My impression is that, notwithstanding the importance of land and machinery and farming, it's fundamentally most akin to private equity, or at least unlisted investment. I have a slide which has gone missing, but it was a list of the major corporate investments in agriculture, and the ones that have worked have tended to be unlisted. Okay? And that's an important point, and I'll try and explain why. This is the fund liquidity requirement for the large APRA-regulated funds. Okay? And what I've done is taken the benefits that are paid out, plus the rollouts, the money that's moving from fund to fund, plus the cost of running the fund, and I've put it over the assets of the fund. Right? So this is money going out the door as a percentage of the assets. And they're very big numbers. Okay? The ones in red are large funds. Right? So you've got very large, this is retail funds over here, industry funds over here. Very, very large retail funds have got $1 in $4 moving out of the fund every single year. Okay, so there's a lot of churn. They're massive funds. The idea is to fund your retirement, which is 10, 20, 30, 40 years away, but 25% of the money is moving out in a given year. So there's a lot of liquidity requirement. It's lower for the not-for-profit funds because they're workplace default funds as opposed to under advice, but it's still significant, right? That means you need to keep assets liquid to some extent. Secondarily, you need to be able to value all your assets at very frequent intervals. Right? And the implications of that are that there are constraints on how much you can have in unlisted assets. And the regulator, APRA, is closely monitoring on a fund-by-fund basis how much money they can have in unlisted assets under the current system. It's the same data for the funds looking at their investment in unlisted assets. So for the not-for-profits, averaging a bit under 20%, and for the retails, averaging a little bit under 10%. So that liquidity requirement flows directly through to the amount of money that can go into unlisted assets. What does that mean for farming? That means you're competing with those other unlisted asset classes within that bucket of superannuation money. This is the same data as a scatter plot. It just shows the relationship between liquidity and unlisted asset capacity. So, what does this show you? It shows you industry funds have got greater capacity, but it does show you that capacity is limited. An additional point is that the trend is that capacity is going down. The reason for that is with the ageing of the population, more people are heading into the pension phase. Right? And they're more engaged, they're more prepared to change investment strategies, so that liquidity requirement goes up. Also, as the system matures, the average account balances go up, and that drives the same behaviour. So there's more engagement, more tendency to look and make a choice about fund and about investment option, and both of them flow into that liquidity requirement. So to summarise, super funds are long, diversified pooled investors, which is compatible with investment in farm assets. There's a desire to invest in local investments to fund productivity, to fund economic growth. However, there's limited understanding, I would say, among the decision makers in our industry, and that may be something we could help with. We could organise a function to discuss these issues. There are also limits to the investment in unlisted asset classes. In the rule of thumb is 20%, but it varies fund to fund. Within that bucket, farm investment is competing against infrastructure, direct property, and private equity. That's the world it's in. And unfortunately, the trend in terms of capacity is the wrong way due to ageing and system maturation. The Financial System Inquiry, the Murray Inquiry, is very acutely aware of this, right? And they're looking at this issue closely. They're trying to explore ways that super funds, retail funds as well, can invest more in nation-building infrastructure and other similar kinds of investment. This will fall into the same category, and they've asked us that question specifically. What would have to change to increase the investment in rural businesses? And so we haven't heard from them yet. They've got a draft interim report coming out in the next couple of months. So it may well go to those issues. Thanks very much.